Picture two people you know, one just bought a rental property, the other put the same money into an index fund. Both think they made the smarter move. Here's the strange part. They're both wrong in completely different ways. One forgot to count the hours, the other forgot to count the zeros. And when you run the numbers over 20 years, the gap will surprise you. Call them Jake and Marcus. Same $50,000 saved, same income, same age, same city. Jake uses his $50,000 as a down payment on a $250,000 rental property. His mortgage runs about $1,300 a month. His tenant pays $1,800. On paper, that's $400 a month in pure profit. Jake feels like a genius. Marcus drops his $50,000 into an index fund, adds $300 a month, and forgets about it. When co-workers ask what he's investing in, he says index funds. Nobody's impressed. On day one, Jake has a house and a story to tell at dinner parties. Marcus has a confirmation email. It's not close in terms of how it feels. But feelings and math are two very different animals. Here's what most people don't realize. By year 3, Jake has collected about $65,000 in rent, but after the mortgage, taxes, insurance, a broken water heater, a roof leak, and a month of vacancy, his actual net cash flow is only $2,000 to $4,000, not the $17,000 that looked good on a napkin. And that doesn't count a single hour of his time. Marcus, meanwhile, has done nothing and watched his $50,000 grow to about $76,000. Zero phone calls, zero emergencies. Now you might be thinking, Jake still wins because of leverage. And he does have one real advantage. His equity has grown to roughly $60,000, and a chunk of that came from using the bank's money, not his own. That's something stock investors genuinely can't replicate. But here's what nobody mentions at the barbecue. Vacancies eat a month of rent a year. Maintenance runs 1 to 2% of the property's value annually. Roofs, furnaces, and water heaters eventually fail in chunks of $5,000 to $15,000. And a bad tenant who stops paying can cost you 3 to 6 months of lost rent in legal fees alone. None of that shows up in the rent check number everyone brags about. By year 10, Jake's equity sits around $175,000. Marcus, with the same 10 years of quiet contributions, is sitting at around $170,000. They're nearly tied. But Jake spent hundreds of hours managing one asset in one zip code, carrying hundreds of thousands in debt. Marcus spent 0 hours and never lost sleep over a broken pipe. By year 20, they land in almost the same place, somewhere between $400,000 and $500,000 each. Jake worked for his. Marcus waited for his. And here's the detail that changes everything. If Marcus had simply raised his monthly contribution by $200, his 20-year total jumps to $550,000 to $600,000. In the market, adding money multiplies through compounding. In real estate, adding money usually means another mortgage and doubling your workload. To be fair, stocks aren't risk-free either. In 2008, the market dropped 37%. In March 2020, it dropped 34% in a single month. Research on investor behavior shows most people panic sell during crashes and buy back in after the recovery, locking in losses at the worst possible time. So here's your actionable step. Before you commit to either path, run the real numbers for your own situation. Not the rent check, not the average return people quote at parties. The actual net numbers, after taxes, after repairs, after the year the market drops 30%. Whichever answer includes everything is the only one that matters. Jake and Marcus both walked away thinking they'd made the smart play. Neither one sat down and mapped the full cost, in dollars, in time, in stress, before they started, so go back to that first picture. Two people you know, both convinced they made the smarter move. The real trap was never real estate, and it was never stocks. It's picking either one off a headline without ever running the numbers yourself. If you've been leaning toward one side this whole video, drop a comment with which one, Team Jake or Team Marcus, and why. Hit like if this made you want to run your own numbers instead of trusting the napkin math. And if you want more videos like this, subscribing means you won't miss the next one.